Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Today's topic is this very hot topic. You see headline everywhere these days about how the court decided that and ruled in favor of CLA that day trading is not allowed in TFSA account. I know a lot of subscribers out there had asked me these questions like, what is day trading? Why is day trading not allowed in TFSA? So today we're going to dive deeper into the court case and use a court case to explain all these. But before I get started, please hit the subscribe button if you haven't already done so, or give us a thumbs up if you find our videos useful, so then you can stay on top of the latest tax tip. Now with that, let's get started. What is a tax-free saving account? So let's just start with this question. Well, tax-free saving account was introduced by the federal government back in 2008, essentially just to encourage hardworking Canadians to save for themselves. It started off by allowing Canadians to contribute up to $5,000 in 2009 to this account, and essentially the contribution is not tax deductible unlike RRSP, but it allows you to put $5,000 aside. If you earn income within that saving account, there is no tax being charged on the income you earn in that tax saving account. Now, for any withdrawal from the account, you would be able to withdraw from the account on a tax-free basis, unlike RRSP. So contribution to your TFSA is non-tax deductible, but withdrawal from your TFSA is also non-taxable. So it is a pretty good deal. Now, at the beginning, $5,000 of contribution may not mean a lot. Now, if you have never contributed to your TFSA account, and assuming you qualify from day one since 2009, the cumulative contribution room available for you to contribute is already at $88,000. Fast forward to 2023, it has been so many years. If you've never taken advantage of this TFSA account, you can now contribute up to $88,000 in one shot. And withdrawal from the account would also replenish your next year's, following year's contribution room as well. So it is very helpful to use this TFSA accounts to allow you to grow your asset on a tax-free basis. Now that you hear this tax-free special saving account that we are all eligible for, some people, particularly people who are really good with stock investment, because stock investments are one of the instruments that you are allowed to invest within your tax-free saving account. So some of these really good traders out there are starting to take advantage of this TFSA account because investment income within the TFSA account is tax-free. So this means that you can just keep rolling up and making more money using your tax-free saving account and without paying any taxes. In this particular court case, the taxpayer was considered day trading in the TFSA account between 2009 to all the way to 2012. He was primarily trading speculative stock, and there is no dividend paying out from any of these stocks. And he was particularly, he traded a lot of penny stock, invested in a lot of penny stock as well. So there's a lot of transactions happening, and CLA go after the transactions behavior and saying, hey, like, you're trading as a business. So you're not really doing long-term investment, and therefore we are going after the benefit and the business income that you're earning within the TFSA is no longer tax-free. You have to pay 50% tax on the income that you've earned from doing day trading in the TFSA account. Now, by this point, you may wonder, like, so what's considered day trading? How do CLA even decide and come to the conclusion that the behavior that this particular taxpayer demonstrated in those years it was considered day trading? Well, as a matter of fact, there is no law that decides what's considered day trading. It's not a black and white type of situation, just like everything else in our Income Tax Act. But the reality is that there are a few criteria that the prior court case have established, and CLA follow those criteria. So there is a total of 8 criteria that CLA look at. The first one is the frequency of transactions. So how often do you trade within your TFSA account, or how often do you trade to begin with? If you trade all the time within your TFSA account, chances are then you are more considered as doing day trading. The second criteria is how long do you own the stock. So the period of ownership matters. So obviously the shorter the ownership, the shorter the duration of the ownership, the more likely your transaction is considered a business transaction. You're an active trader. The third criteria is your knowledge in the security market. So if you are working in a job as a day trader, or you are a financial analyst that participates heavily in this type of market, so obviously from your profession, you would demonstrate in-depth knowledge in the stock market. So under that circumstance, CRA would typically consider you more likely doing day trading rather than long-term investment. And therefore, your trading within your TFSA account would be more likely to be considered on the day trading side. So the fourth criteria is whether the security transaction forming part of your taxpayer's ordinary business. Well, if you are already doing day trading outside of your TFSA account, because it's only logical that you would have multiple accounts doing trading to maximize the amount of income that you would be able to get. So if you are doing trading as a business to begin with, or if you are helping people to do trading, some of you guys could be out there helping other people trade as a profession. So if that's the case, your transaction within TFSA is more likely to be treated on the day trading side rather than a regular long-term capital investment that CRA had the TFSA set up to do. The fifth criteria CRA look at and the court look at is how much time you spend on researching the security market and potential purchases. If you spend a lot of time doing this on a daily basis and you publish it on social media, CRA also has access to social media, just so you know. So you are more likely to be considered doing day trading rather than doing long-term investment. Now, how much debt you would use to finance the transaction. So in the TFSA scenario, you're not allowed to borrow money. So you're not allowed to go into margin. TFSA is a cash-funded account, so you're not allowed to go into margin. And so this criteria probably doesn't apply. Because you are not borrowing at all. The seventh criteria is your advertising. Well, you're not doing advertising. TFSA doesn't allow you to do advertising to buy the stock at a discount, so you're not doing that. Now, the last one is the nature of the stock. If it is shares, are they speculative in nature, or do they provide long-term dividend? So those would be the 8 criteria CRA look at. If you're buying a speculative stock, just like penny stock, and it goes up, so some people asked me last year about GME, GME stock, and as if you don't know, look it up. And some people participated in this speculative behavior and earned a bunch of money from selling GME stock or AMC stock at the time as well, and they don't pay any dividend. And so would that behavior allow in TFSA account? Well, the reality is that it's considered speculative in nature, and chances are CRA would treat that as day trading as well. So now that we cover all these criteria on analyzing whether a transaction or your behavior, how to determine whether your trading behavior is considered day trading, you can see that it is actually very fussy. You can argue it either way. And so this is exactly the case in the argument that the taxpayer in this particular court case had mentioned. So instead of arguing that he's not doing day trading, the court case, in this particular court case, the taxpayer is arguing that it's unfair to use the criteria, the 8 criteria that we just mentioned, to evaluate the trading behavior within TFSA. His argument is that with TFSA, because of the tax-free nature, Canadians generally are more inclined to taking on more risk to make more income as a result. And because the income accrues are free of tax within the TFSA, so the TFSA investor would be more inclined to sell to realize the gains earlier and more often than a taxable investor. And because the losses within TFSA are not deductible from other income, so the TFSA investor would be more inclined to sell to cut losses more often, and therefore the frequency of the transactions would be way higher than a regular taxable investor who invests outside of their registered account. And he also argued that some of the criteria that the court uses, including the advertising, the ability to get debt financing, they're not applicable to the TFSA investor because they're cash-funded account. So to use those criteria, the 8 criteria that I mentioned earlier, is completely wrong. And he actually proposed to court to use a separate set of criteria. And I mean, I have a lot of respect for this particular taxpayer because he tried and went around the history of how this was created to argue with the court to provide him with a support that new set of criteria should be established to evaluate the trading behavior within TFSA. So kudos to him. He proposed to the court that if the TFSA trust business occupied the taxpayer's time, attention, and labor, the TFSA incur liability in the course of its business, and the purpose of the trust was to provide livelihood to the taxpayer. These are the 3 new criteria that he proposed to the court to adopt to evaluate the trading behavior of a TFSA trader. Well, unfortunately, obviously, CIA did not accept that, and the court did not accept that at all. And he also argued that day trading is allowed in RRSP, and he's using that argument to compare to TFSA, and he's arguing that the RRSP day trading behavior is allowed, and therefore TFSA day trading behavior should also be allowed. Both are registered accounts. But the reality is that CIA argued that RRSP trading, even if you do day trading within RRSP, the withdrawal from your RRSP is taxable, 100% taxable as regular ordinary income. So as a result, the purpose of RRSP and TFSA is completely different, and therefore the court is not buying into that argument at all. There are 2 different instruments, and therefore there are 2 different set of rules governing the 2 different type of registered account, and unfortunately, the taxpayer lost, and therefore he's stuck with paying the court cost, the cost of going to the court, as well as also paying taxes on the trading income, day trading income that he has earned from TFSA. It's sad, but it is a good example to go through. Now that you have a good idea in terms of the criteria that CIA and the tax court are using to evaluate taxpayers' trading behavior to decide whether they are doing day trading or not, then you can now look at your own trading behavior and see if your behavior are more likely to be on the day trading side or a regular long-term capital investment side. And then you'll know if you are under CIA scrutiny, you are at high risk of being audited. Now, if you find our video useful, please give us a thumbs up and hit the subscribe button below, and tell us your trading behavior below, and tell me if you are thinking that you're doing day trading. Until next time, thanks for watching.